headed, and let's try to connect with our experts then and try to find out that in the market right now, what should your strategy be like? And let me welcome on board Sunil Subramaniam, who's a market expert, joining us on the show. Good afternoon, Sunil, and thank you so much for your time. Firstly, help us with your take on the markets. How are you catching the pulse, and what factors are already at play?
I think the markets are going to be range bound because of the BTA expected. I think Sir Trump has been, as usual, speaking a lot about issuing a letter, announcing tariffs again, the extension of the pause and all of that. But I think the news for India, I think, is that he's been saying that we are close to signing a deal, and our teams have been there and actively discussing with them. So I would say that that's what the fresh direction for the market. I mean, today's the regulatory announcement on Jane Street, of course, create a little bit of volatility. But otherwise, I see that the undertone of the market is quite okay. The BTA announcement plus the earnings season pan out are going to keep sector rotations happening, right? Because where we win in the BTA, those sectors will do better. Where the earnings season comes out good, they'll do better. So I expect a lot of market churn. Domestic liquidity continues to be strong, and so broader market will have support. FII returns will depend on I think, of good PTS data coming out on terms of BTA signing from the US and India. I think FIIs are probably waiting for that to make a stronger comeback.
Okay, so that's the take on where Sunil sir expects the markets to head. But Sunil sir, the kind of recovery that we've seen from the day's low coming in all seems like we might just be ending Friday on a cheerful note. It's names like Pharma, IT, Realty that are doing well. FMCG has once again made its way to the green. Do you believe now is the time to bet on defensives and let the external facing sectors take a little bit of a backseat in the portfolio?
Look at it. The kind of sectors which have gone up today indicates that when the data comes at the end of the day, I think FIs would have made a return today. Because typically their favorite sectors are FMCG, banking, and IT, right? And those are the ones, and pharma, for example. So while you might label some of these as defensives, I think it's the FIs who are probably now with the BTA coming close are saying, okay, now things look better for India, and it's their return. So to that extent, as a market participants, I think in the shorter term, it makes sense to buy what the FIs will buy. And to some extent, it's also that which has underperformed in the recent past. So if you take over the last 6 months or a YTD, right, you've seen IT underperform, you've seen realty underperform, you've seen consumer underperform. And typically when FIs come back, I think that maybe not realty so much, but definitely IT and consumption, especially FMCG, would be on their radar. So I think from a tactical play, it makes sense to smell the money and go to what because I think that's the big story, right? The FII return. They have been very choppy and volatile. Domestic flows have been consistent and buying domestic strong sectors. So I think if you then look at it from that perspective, right, your immediate reversal to mean of those which underperformed in the recent past is probably going to be the story. So I would actually pick those which actually today are actually playing out as your short-term things which will provide support to the market.
All right, so that's the take coming in on the FII flow front and the sectors that you should be watching out for. But Sunil, a lot of these updates from the financial space have already trickled in. Any trend that you are picking up within the financial basket? Because of late, yes, the credit growth has been slow, and for the major banks, it has been in the single digit, while the deposits, they are seeing an uptick. That's a double-digit growth that the banks and financial companies are holding. But what are you making out of it?
So I think that's right, that it's obvious that credit growth, industrial growth is not yet picked up, and retail growth probably the first quarter of the year. People are still baking in what are the tax savings from the tax ways and because a lot of their loans, like personal loans and auto loans, are at fixed rate. So from that point of view, banks may now be actually to cut deposit rates further because they are seeing there's not enough credit demand growth. And so in the next few months, I expect that the NIMs should be fairly strong, which is actually quite good. The second aspect is that I expect bank, which are mostly a lot in the insurance and mutual fund distribution space, right? Because some of this liquidity, if it's not getting spent, saved. And those savings are all what flowing in now into the banks in deposits, but will also flow in through mutual fund, through a growing SIP. From that point of view, while overall top line growth for the banks may not be great, I think the NIMs will be fairly protected in the coming quarter.
The take on the entire banking and financial space. But while we are talking about this space, let's also bring on board my colleague Varun, who's standing by with a list of all the banking and financial names that have come out with their Q1 FY26 updates. Varun, over to you.
Well, so let me start with NBFCs because both Bajaj Finance and L&T Finance are up in trade today after the quarterly updates. Bajaj Finance, no doubt the AUM and the deposit growth are at multi-quarter low, but they are as per guidance. Now the AUM growth has been 25%. The company has guided for 24 to 25% growth in FY26. Also the deposit growth has come at around 15%. The new loans book, they have grown up by around 23%, and the customer franchisee that has gone up by around 21% on a year-on-year basis. L&T Finance, the total retail disbursement is up by 18% for Q1 FY26. But if you look, it has been aided by the recently acquired gold portfolio. The overall contribution from that was around 1350 crores. Excluding that, the overall growth has been 7.7% for this company. The company has guided for a 20% growth in FY26 in the overall loan portfolio, and this quarter the overall growth in the retail segment has been around 18%. Now let me come to Bank of Baroda. The overall global advances, they have grown by around 12.6%. The overall deposits, global deposits, they have shown a growth of around 9.1%. So it has been a good, decent growth for Bank of Baroda, although not the high 20% growth that the company used to deliver earlier. UCO Bank, the overall growth has been decent. The total deposits that have gone up by around 11.57%, advances have gone up by around 16.6%, but the CASA ratio that has actually fallen down from 37.9% to 36.9% on a quarter-on-quarter basis. RBL Bank, total deposit is up by around 11%, advances up by around 9%. The CASA ratio that has actually come down from 34.1% to 32.5% on a quarter-on-quarter basis. But if you look at the overall retail portfolio, the secured loan portfolio that has grown by around 23%, so that's good, and the unsecured retail advances, they have actually gone down by around 7%, but yes, the CASA ratio that has declined. For Bandhan Bank, the biggest highlight was the CASA ratio, which has shown a decline from 31.37% to 27.06% on a quarter-on-quarter basis. So that's a very sharp decline for Bandhan Bank on the CASA ratio front. The total deposit, total loan book, especially has gone up by around 6.4%. And HDFC Bank, that has just come, hour before, the overall advances, they are up by 6.7%. The deposit, the CASA deposit, that has gone up by around 8.5%, but on a quarter-on-quarter basis, it is down by around 0.8%, and the overall deposits that have gone up by around 16.2%. So the deposit growth has been good, the advances growth has been good for HDFC, but yes, on a quarter-on-quarter basis, the CASA ratio has slightly declined. So that's one thing for the highlight in HDFC Bank also.
So much, Varun, for getting us all those details. So those were your movers in the trade right now. But time now to slip into a very short break in this edition of Closing Trades. Don't go anywhere. We'll be right back on the other side.
Hi there, welcome back to Closing Trades. Let's just mark the recovery that we've seen in the markets right now. You have Nifty 50 that's once again in the green now, almost a 0.2% uptick coming in. We're very close to reclaiming that 25,450 mark now. So looking good for the Nifty as of now, and it's a 100-point plus recovery from the day's low coming in for the Nifty. Similarly for Nifty Bank, almost a 400-point recovery coming in from the day's low, and we are seeing an uptick on Nifty Bank right now too. In fact, it has been a sharp uptick because Nifty Bank is higher by almost 0.4%. So very sharp uptick coming in on Nifty Bank as we speak. Similarly, Sensex too has made its way back into the green, a 0.2% uptick coming in on the Sensex. Let's see if this has reflected to the broader end of the market. No, because Nifty mid cap is still lower by 0.1% and Nifty small cap is absolutely flat, trying to edge its way into the green. But as of now, the broader end continues to remain rather flat in today's trade. But while we are talking about stocks, and how the way the market is moving, and stocks that are not doing well, and topping that list today is Trent, because it's an 11.3% cut coming in on Trent once again. Even though the market has recovered, none of that has been reflected onto the Trent stock as we speak. But on the back of this tepid Q1 business update that the stock has given, remember this number for the revenue that they've given has come in at 5,061 crore rupees, which is 4% lower than the overall street consensus of where the revenue was expected to grow. This time around, on the back of management commentary as well in their AGM that was held yesterday, they've said that growth trajectory remains underwhelming. They have given a 20% growth guidance for their fashion business, which is significantly lower than the 35% 5-year CAGR at which that segment has been growing. Also, Nuvama has downgraded the stock to a hold rating from a buy and also trimmed the target price. In fact, we also spoke with the author of that note at Nuvama, Abneesh Roy, who has downgraded the stock. Let's go across and revisit to understand his rationale behind this move and this rating on Trent today.
Longer term, we do expect Trent to come back, and Trent will also scale up new growth drivers longer term. Zudio Beauty and Star Business, we see that longer term those can become the next big growth drivers, but it will take some time. If you see, some of the other fashion retailers have also said that because of the festival shift, etc., Q1 numbers, there was some weakness in North India. So overall, I think in Trent, fashion business, strong base and overall festival shift, etc., has led to some level of slower growth. There is an urban slowdown, which we have been highlighting. So it's a mix of all this. Long term, I think Trent remains a compounding story. They have a vision to scale up revenue 10x. And already from a FY23 perspective, they have doubled the revenue. So we do see 250 stores addition yearly. If they can come back to a 25-30% kind of growth in the core fashion business and overall, I think the stock can re-rate post that.
All right, so that's the take coming in on Trent by Abneesh itself. But talking about the charts, yes, it's an 11% fall, but a mild recovery from the day's lowest point is what we have already seen on Trent as well. But for this, let's also welcome on board Arpit Beriwal, Manager Derivatives, Equity Research at Motilal Oswal. Hi Arpit, afternoon, and firstly help us with your take on Trent, because I believe that it's now back to its May low levels. Give us your sense on the stock and where do you see the stock headed? Do you believe that this kind of a fall will take too much of a time to actually recover?
Yeah, so very good afternoon to all. So if you talk about trend as a chart structure wise, if we see overall, since last 7 to 8 weeks, the stock was in uptrend and the stock slowly moved from 4,600 to almost 6,000 levels. But today we have seen a big dent from the higher levels post its action, and looking at the chart setup wise, almost you've seen a correction of 12 to 13%. So talking about the level wise, the next major support is around 5,400, and if you see the setup wise, 6,200 to 5,400. Now 5,400 is a major support. Further weakness can be seen below 5,400 levels towards 5,200. So it's better to wait and watch. Generally after such a big hit, it generally takes the stock to consolidate. So 5,400 would be immediate level to watch out for. If it closes below that, we can see some more pain towards 5,200 levels.
Those are the levels to watch out for on Trent. Sunil sir, before we let you go, just wanted your thoughts on Trent today. The kind of fall the stock has seen, if you take a look at the numbers fundamentally, it's not, at least on the revenue front, it's just a 4% miss compared to the Bloomberg estimate. Do you believe that this kind of sharp dip that we've seen today on the stock, more than 11.5% now, is warranted? Do you believe that this is panic selling on the stock today, or do you think this chart today, or this move that we've seen on the stock rather, reflects a broader loss of market confidence in Trent?
Well, I can't talk stock specific, so You'll have to excuse me on that one.
Just zoom out a little bit and talk about the entire retail space, because on one side you've seen value retail, the smaller players that are making big moves, and then you have on the flip side big players that are not making small moves at all. In fact, very insignificant moves coming in. So Neil sir, any take on how do you see retail as part of the consumption pack shaping up?
See, overall, I'm positive on retail, and I'll tell you that those retail numbers should look up because, as you know, there's a 1 lakh crore of giveaway from the finance ministry to the middle class, right? But what are they going to do with their money is a question, right? So if you now look at it from that perspective, a lot of the retail names are carrying very high growth trajectory for the past. And so the P ratio of these high-end retailers carries that high growth expectation. Okay. So what happens is that, but are people going to actually keep buying more of the high-end stuff, or is the economy's recovery going to be more broad-based? Because, you know, P stocks which are at a high P in the retail space are those which have benefited from the K-shaped recovery of the economy, which is the higher value goods grew faster, whether it's in real estate, whether it's in auto, whether it's in actual retail consumer buying. It's the richer people who've been spending. The broader middle class has been off. And we have seen that for quite a few quarters now, right? Now, with this move of the finance ministry to pass on, it'll take a couple of months for people to feel the cash in their pockets, you know, as their tax deduction comes down, the quarterly advance tax date is just over. So when that happens, the broader people are probably like to buy more mass consumption products rather than the high-end products. But those mass consumption related retailers were actually not the favorites of the market because the market had always been pricing in the K-shaped recovery sustaining and continuing. So now when the result season unfolds, right, I expect that the broader retail, which is catering to mid-market and to the mass market, as opposed to the larger end of the market, to actually do better because people are going to have money in their hands. But the ones which are growing at 30-40% and the P ratio is expecting to grow, they're not going to be able to sustain that because at the high end, people are buying, they're buying. So I think that's the reason that valuations become very important as you now go into the retail. Overall, retail should do well, but you got to pick, I think, those where high future growth is discounted are probably going to be in for a nasty surprise. Whereas those which are actually flagging a bit will probably get a leg up now, especially with the monsoon coming and the rural side consumption also stepping up.
Absolutely, Sunil. So a lot of factors at play, but yes, the high P counters are getting hammered. But thank you so much today for taking the time out and helping us with your take on the markets and very interesting take on the retail side as well. But time now to